Optimistic on reform, but warning bells on growth and the fisc, and yet another nudge to the central bank to ease interest rates. That, in essence, sums up the mid-year economic survey, which has been tabled in Parliament. Hello and welcome to this special edition of Indianomics. I'm Lata Venkatesh. The report has emphasized that there are downside risks facing the economy, and achieving that 7.5% growth forecast looks difficult. This is the upper end, of course, of the government's projection. The RBI's has been 7.3. Another crucial warning is on the fisc. The survey cautions on fiscal slippages due to the farm loan waivers, that's on the state side, and on other spending sprees. But at the same time, it remains upbeat on meeting the fiscal deficit target. The survey also points out that inflation is likely to remain below the Reserve Bank's 4% forecast, and describes the scope for monetary easing as, in quotes, considerable. The survey argues that cyclical conditions suggest that the policy rate should actually be below the current rate. So in summary, the survey arrives at this conclusion: economy is yet to gather full momentum and still away from its potential. So this leaves us with three key questions. How serious is the warning on growth? Should we worry about fiscal slippages and the year-end fiscal deficit target? And third, should the Reserve Bank be more accommodative and cut policy rates? Joining me to discuss this are three top economists from the country: Sajid Chinoy, Chief Economist of JP Morgan; Soumyakanti Ghosh, Chief Economist, Economic Advisor at SBI; and Siddharth Sanyal, the economist from Barclays. Gentlemen, welcome. Before I start the discussion, let's listen to Dr. Ramlal Jalan, former Reserve Bank Governor, who also was reacting to the initial comments from the economic survey mid-year review.
If I read all the forecasts, everybody is talking about it because of the impact, delayed impact of demonetization and so on, that the rate of growth may be lower than 7%. I mean, whether it is, with what decimal point it is, I can't say. I mean, it can be 6.8, 6.7, but there is a view that the growth rate would not be what it was in last year, 15-16, that 16-17 would be lower. And that makes sense. We know that inflation rate would be low. I mean, whether it is 3.5%, 4%, and that the situation is much better than what was anticipated. And that part of the reason for the situation being much better is that consumer demand has gone down, amount of investment in the economy has gone down, and supposing all these changes, infrastructure investment increases, consumer demand increases, then the rate of inflation may also be higher.
Okay, that's Dr. Jalan. Actually stressing that the delayed effects of demonetization will be one reason why there will be question marks on growth, though he doesn't want to commit. Now, let me come straight away to that paragraph in the economic survey's first chapter, page 27 actually, where the survey is actually challenging whether we will be able to reach even 7% growth. What the survey is saying is that at the moment, the real growth in investment is 4.5%. In exports, it is 2% volume, and a decline in credit to GDP ratio of 2 percentage points. If you keep these parameters and look at any of the past 25 years, we have not been able to generate 7% growth. So that really is the question. If you have this kind of a capex growth and export volumes, partly because of a strong rupee, I would assume, can we really generate, and of course credit growth of just about 6%, then can we generate 7% growth? That is the question they are asking when they are challenging the current growth forecasts, which is about 7.3, 7.5. So let me come to you, Sajid, first on that. Is this a fair argument? Exports are not firing so much because of probably a strong rupee. The investment capex is nowhere where it used to be, and credit 6%. So how will you get to 7% is what they're asking.
No, it's a very fair argument, and I think I want to compliment the authors of the economic survey, because one theme you've seen over the last 3-4 years has been great honesty in the survey. And this is not the first year the survey has worried about growth. If you go back to the last 2 years as well, the survey makes the point that we're in an environment here where we're going to be struggling for growth to accelerate. I completely agree with the survey's conclusions on growth. We've had a similar view for the last 2 years. The fact is, India is in the midst or in the start of a deleveraging process. So in fact, credit growth should be even weaker going forward for the deleveraging to happen, number one. Number two, there was great optimism at the start of the year that exports would provide a significant tailwind to growth. We've seen that happened for 1 or 2 months. The last 3 months, in fact, things have been reverted. So, exports will be just modestly better than last year. Number three, I think the part we don't focus enough upon is the acceleration for growth in 17-18 was predicated in part of a very sharp recovery after demonetization. But as we've said in the past, even in the first quarter of this fiscal year, the recovery has been incomplete and patchy at best. And finally, I think, as the survey kind of points out, fiscal policy here is going to be neutral. The fiscal consolidation at the central level, in my view at least, may be offset partially by states. So you won't have any benefit from fiscal. So keeping these factors in mind, we're of the same view here. Growth is going to remain soft, may well dip below 7%, and and so that's something we have to all accept, learn to live with.
Oh, below 7%. What's the number you're working with, Sajid?
Our current forecast is about 7.2, Lata, but there's so much uncertainty in the current forecast because a lot of it hinges on some sort of recovery after demonetization, and a lot of it hinges on some pickup in exports sustaining. And in the last couple of months, both the export numbers and the fact that you've seen increasingly import substitution, the fact that non-oil, non-gold imports have been strong while domestic activity indicators have been soft, I think those create some downside to the forecast we work with.
Okay. Shaumya, similar question to you. I don't know how much of the survey you could read. I couldn't read much, only patchily the first chapter. But would you agree with the questioning of the growth numbers itself? RBI's is 7.3. The survey is merely asking that do we have all the coordinates for a 7% growth?
No, I think as Sajid rightly pointed out, I think the economic survey has been very honest in terms of the growth assessment. And as of now, our growth forecast is also at 7.3%, but we believe that there are significant uncertainties. The primary uncertainties, if you look into the credit growth, I mean, just the credit growth, if you look into this year, the contraction in credit growth has been 1.5 lakh crores. So that is a big number, and the problem is it is happening across all sectors. Service sector, the housing sector, the only sector where it is growing this year is the personal loan segment, but I don't think that is basically the credit creation, because it is just giving you credit against your personal liability to the bank. So my sense is that, I mean, growth is going to remain weak. The export growth rate also, the rupee appreciation is also a significant factor. Export growth rate is going to be weak. There is a lot of imports from China. There is an element of domestic uncertainty in terms of the overall domestic industry is doing badly. So I think if we take all these factors, so there are too many moving parts in the room, and if we take all these factors into account, I agree with the assessment that there could be a downside. The downside estimate to the growth numbers which has been put out in the economic survey.
Okay, well, let me come to the fiscal side of the equation. The survey is saying that GST could give some outsized benefits. They go on to say textiles was never included. The imports were always taxed at, SAD and not at the special additional tax, used to be 4%, whereas internally VAT was 12.5%. And now, since there is more equivalence and recognition, there will be duty set-offs. They go on to say that the tax base has expanded. 6.6 lakh new people have registered, and you can now get the direct expenses of these guys who are in the tax net, and therefore direct taxes will improve. Yeah. While they say this, they are still questioning, because of farm loan waivers and because of overall growth issues, whether the fisc will be strained, and therefore it cannot even it will cut down on plan expenses. Where do you stand? Do you think we are going to surprise on the upside in the fisc, in revenue collection?
So there are many moving parts. You mentioned about the GST. GST is a big uncertainty, and we still don't know whether it will really be a positive surprise or a negative surprise, but it can potentially be a surprise, a sizable surprise, in which direction we are still not completely clear. What is somewhat more clear is on the direct tax side, where it looks like that after the demonetization there is greater compliance, vigilance is stronger, and possibly we see continued upside support from that particular side. So that remains supportive. The other area where the government had been getting some support earlier is the dividend, etc., from the PSU, where there was some kind of a quote-unquote disappointment yesterday. But I think in that kind of a scenario, another very important question is what we get to see on the disinvestment front. Okay. We have seen considerable disappointments over the last several years, but we managed to meet the fiscal targets. In this particular year, it might actually be a lot more crucial, because that's another sizable chunk of revenue or resource estimate for the government.
Okay. So, well, you know, what the survey says is that obviously even if the fiscal resources are not there, planned expenditure will be cut, and that will be a negativity on growth. So their conclusion is that the fiscal discipline will be maintained, but they're wondering if there can be some cut in plan expenses. Well, let me get one more question in, and then get into the big inflation and interest rate issue. The survey says that we have probably moved to a new normal in oil and in agricultural productivity. Would you agree, Sajid, that therefore we have to reassess inflation altogether?
I agree with those 2 points the survey makes completely. I think, you know, the fundamentals of the oil market have changed structurally. We've gone from having a floor on oil prices to having a ceiling on oil prices, and that ceiling is progressively getting lower every year with the advent of shale technology. So I think that's exactly right. I think the other part the survey makes is also correct, in the sense that you know, it points out we've had systematic inflation surprises to the downside, and as we've previously said, I think some of that is because some of the food disinflation we've seen in the last 3 or 4 years clearly has structural components to it. Otherwise, it's not possible to bring food inflation down, which was running in double digits for 6 years, down to 3 or 4% when you have back-to-back drought years. So I think on both those fronts, the survey is right that you know, there is a supply-side element to the food inflation, and the worries about geopolitical risks associated with oil, I think, are less today. And perhaps from in that respect, the survey is right that there is a paradigm shift happening with inflation. I would argue not just in India, around the world. You've seen downside surprises to inflation around the world for the last year or two, and that's led to this argument that maybe the Phillips curve around the world has become flatter or has a kink.
Yes, and the survey adds that on the minimum support prices front, the price support front, the current government has responded by changing the framework in which agricultural prices are determined. It has rationalized MSPs, minimum support price awards, liberalized agricultural marketing arrangements, and institutionalized the inflation targeting monetary policy committee framework. Now, Shaumya, given this, do you think that the survey is right in arguing that the Reserve Bank is missing the point, that there is a longer-term structural shift in inflation?
No, I agree with the point that there is a longer-term structural shift in inflation, because even if you look into the index, if you look into the CPI, the retail inflation which the RBI tracks in terms of inflation targeting, and the index over the last 3 years, you will find that, in fact, the food index has barely moved, and it was the case before demonetization, and after demonetization there obviously has been a fall. So there is both a structural impact to it and a transitory and a transient impact and a structural impact to the food inflation. Now, having said that, in terms of whether the RBI, I mean, in terms of whether the RBI has missed it or not, yes, there has been inflation numbers in the past which has been significantly on the upside, as the economic survey rightly points out. But the good thing is that if you look into the latest inflation projections by the central bank, these are now more on in line with the expectations which the market has. It may still has an upward bias, but that is understood that in an inflation targeting regime, the central bank always wants to play a little bit cautious and tend to project the inflation number on the higher side. But as long as the difference between the two is not much, I think that should be taken with a caution by the market in terms of the, future accommodative monetary policy regime. So in my sense, I think that's a point of debate which we can get into.
Okay, that is the point of debate that we are going to get into. Is there a structural shift in inflation, and are there serious dangers to growth, and therefore should the Reserve Bank rethink its stance? That debate raised by the survey to my panel after this very short break.